Um, Hi, everyone. This is Colin. And today I'm going to talk about the latest market news and how it affects your investment decisions. And let's get started. The stock market closed with losses today as rising inflation and interest rates spooked investors. The S&P 500 fell 0.62%. The NASDAQ composite dropped 0.63%. And the Dow Jones Industrial Average slid 0.5. The main catalyst for the sell-off was the release of the September Consumer Price Index, which measures inflation. The CPI rose 0.4% month over month, slightly above the consensus estimate of 0.3%. On a year-over-year basis, the CPI was unchanged at 3.7%, the highest level since September 2011. Core CPI, which excludes food and energy, also increased 0.3% month over month and dropped to 4.1% year over year from 4.3% in August. The inflation report showed that price pressures remain elevated across a range of goods and services, especially shelter, food, and energy. However, some analysts pointed out that there were some signs of moderation in some categories, such as used cars, medical care, and education. They argued that inflation will likely peak soon and start to decline in 2023 as supply chain bottlenecks ease and demand normalizes. The bond market reacted negatively to the inflation data as higher inflation erodes the value of fixed income payments. The yield on the 10-year Treasury note jumped 12 basis points to 4.71%, the highest level since July 2011. The yield curve, which measures the difference between short and long-term interest rates, also steepened, indicating that investors expect more rate hikes from the Federal Reserve in the future. The Fed has been signaling that it will start tapering its monthly bond purchases by the end of this year and raise interest rates sometime in 2023 to combat inflation and support the economic recovery. However, some market participants fear that the Fed may be behind the curve and may have to tighten monetary policy more aggressively than anticipated. Another factor that contributed to the market volatility was the ongoing geopolitical uncertainty. These issues have raised concerns about global stability and growth prospects. The US dollar also strengthened against most major currencies today as higher interest rates made it more attractive for investors to hold dollar-denominated assets. US dollar index rose 0.7% to 106.58. A stronger dollar tends to hurt US exporters and multinational companies that earn revenues overseas. So what does all this mean for you as an investor? Well, here are my takeaways. First, inflation is still a major risk for the stock market, but it may not be as persistent or severe as some fear. I think inflation will moderate in 2023 as supply and demand imbalances resolve and base effects fade. Second, interest rates are likely to rise further as the Fed begins to taper its bond purchases and prepare for rate hikes in 2023. This will create headwinds for growth stocks that rely on low borrowing costs and high future earnings growth. Third, value stocks may offer better opportunities in this environment, especially those that can benefit from higher inflation and interest rates, such as energy, financials, and materials. Fourth, geopolitical risks are also a source of uncertainty and volatility for the market, but they are hard to predict or quantify. I think it's important to diversify your portfolio across different regions and sectors to reduce your exposure to any single event or outcome. And fifth, the dollar may continue to appreciate against other currencies as long as US interest rates remain higher than those of other countries. This will hurt US exporters and multinationals, but it will also make foreign assets cheaper for US investors. That's all for today, folks. I hope you found this video helpful and informative. If you did, please give it a thumbs up and subscribe to my channel for more financial insights and analysis. And don't forget to hit the bell icon to get notified of my new videos. Thanks for watching, and I'll see you next time.